then you can go.
Okay, good morning everyone. We're going to start our morning call now. So I'm Kenneth, and today we're just going to do a brief market technical analysis, and following me will be Nicholas, who will be giving you the O&M and commodities takeaways for this quarter. Okay, so let's get started. Okay, so just to do a quick summary, today won't be long. Macro conditions still suggest to, in general, overweight equities right now. Okay, one thing to note: the U.S. market, we think is longer term bullish. Okay, but right now we do recognize that it is a short term cautious grind up, or you can see it's drifting along. But I will still call the trend bullish. Industrial commodities, we are neutral weight. Okay, we are definitely underweight gold, and the charts show that it's longer term and short term bearish, so please stay out. For bonds, we are longer term bearish. Okay, we are longer term bearish, but technically speaking, the secular downtrend has not started yet. Okay, I'll show you the chart in a moment. STI, we are longer term bullish. We believe right now we are in a short term consolidation. Okay, lastly, overweight China. We've been giving this call for months now, 2 months I think. We are longer term bullish, and this week we have what we believe to be the first signs of a short term potential breakout. Okay, so let's check this out. Okay, just to start with gold. So gold, we note that price has actually broken out from this consolidation region here. So we've broken out and we've paused. Okay, but this technical formation right now, unless price can actually retrace and climb above this level, is actually bearish. So we are short-term and long-term bearish on gold at this point, unless gold can actually reclaim back this bottom support / resistance level over here. Okay. We also note that despite this decrease in gold, there's also been a decreasing performance in gold miners as well. Okay, so this doesn't bode well. So this gives added weakness to the gold price chart, basically. For S&P 500, I will call this a marginal drifting higher. We've got slightly bearish candle here, slightly. Breadth indicators are slowly improving. Okay, so what I see here is basically a very, very mild uptrend with very little volatility. It wouldn't surprise me if the price actually corrects a little bit more. But based on macroeconomic data, right, I don't really expect the price to drop below this support line here, which is the upper side of this triangle. Okay, at this point I don't see it breaking back into it. But if it does, we might have to change our thesis. But as it is, unless the price drops back into this channel, we are going to assume the uptrend is in place. Okay, sector glances is just for your reference. We've talked about this for some time. Okay, just want to point out that the utilities are continuing their downtrend. As you can see, the relative performance between the utilities and the SPX is down. Okay, consumer staples also resumes their downtrend. Okay, energy is basically flat. It's correcting in this cycle, but it's flat here. Okay, and the offensive sectors like cyclicals and industrials, right, continue their leadership. So taken together, right, this corroborates where we think we are on the sector rotation chart over here. Okay, energy is undergoing a correction, hence it has not reached the leadership yet. Basic materials is also correcting, so it's not hit leadership yet, and industrials and technology and cyclicals are still strong. And of course, utilities continue its underperformance. Intermarket relationships. Here, the top chart is the US Treasury 10-year chart, and as you can see, we have short-term weakness here. Okay, but this multi-year uptrend line has not been broken yet. So we expect this line to be challenged, and we have to see whether it actually breaks through. Okay, obviously a breakdown of this line would confirm our bearish thesis on US Treasuries. Okay, Dow Jones World Index is still essentially on an uptrend, and the industrial commodity chart continues its gradual downtrend. Okay, we believe, based on the thesis of where we are on the economic cycle, that eventually commodities has one more run up to go. Okay, but we don't know when that's going to happen. That can only happen when this line is broken. Okay, a recap on oil service sector. This is last week. Last week's chart, I mentioned actually this. Uh, we suggested a trade down here at $45, and the target price was supposed to be 52. We almost reached there, and then we had a weak candle. So based on this weak candle and also other asset classes that I was looking at, I did ask conservative investors to move their stop loss higher to $49. So this week, as it turns out, there was weakness, as I expected, and well, you would have been stopped out if you've taken this $49 stop loss. Okay, so you can take your profit from here. However, whenever you have a case where you have a multi-year head and shoulder pattern, as what we have here for the OIH, on the first breakout, right, the probability of having a second move up, that means after this correction is over, a second move up is actually very high. So it's possible, if price comes down again, that if it comes back to the 45, 46 level, that would be a good time to re-enter again, because the bull market for the oil sector is not over as yet. Okay, it's not over yet. It's just following the correction in crude oil itself. Okay, so this is where we are, where we think we are on the business cycle. Okay, to recap, we are bearish on bonds, and we believe stocks and commodities still have legs to go. Okay, commodities have more legs than stocks. Okay, China, right? Okay, so this is what the chart looked like last week, and I did say that ever since the third plenum news came out, which was 2 weeks ago on this candle, I said there's a good chance that price is going to surge up and challenge the line again. So last week, last week, it did challenge the line again, and it conveniently bounced off this downtrend line over here, as you can see. And this week, the price is cautiously peaking above this line. So that definitely bears watching. And is this the first sign of the multi-year breakout? We think so. So this week, we definitely need to see if price can stay above this, the breaking of this downtrend line. If price can stay above here, that will corroborate add further encouragement to our thesis that this was a double bottom. Okay. Now, of course, we make this call also based on improving macro conditions in China. Manufacturing data has been better than expected, etc., etc. And now there's talks of economic reforms. So this also gives a fundamental story for China. Also note that at this point, China's fundamental valuations is attractive. It's the CSI 300 PE is below 11 times, between 10 and 11 times, I believe. And the China market itself is going at a PE of 10. And note that as of now, the Asian indices have an average PE of 14. So there you have, so for China, you have a historically attractive valuation as well as attractive relative valuation compared to its peers. Okay, so definitely keep your eyes peeled on this China chart. Finally, for Singapore market, once more the consolidation continues. Okay, so in every consolidation, there's a chance that there'll be a move up or move down, obviously. Right now, based on macroeconomic data, encouraging fundamental data from Singapore as well, we are biased towards up. But of course, technically speaking, it's only going to be confirmed when the price actually breaks above this consolidation pattern. If the price breaks lower than the consolidation pattern, we have to rethink our thesis. Okay, but if it does break down, then support is pegged at roughly 31.20. That's the support here. And if that's broken down, the next support is about 30.25. Okay, so that's it for the market technical analysis. I'm going to pass you to Nicholas, who will talk to us about the OAM and commodity season takeaway.
Hi, today we'll be talking about the results season takeaway for our coverage companies within the O&M and commodity sector. Let's first take a look at the commodity sector as a whole. On the demand side, CPO CPO price is pretty range bound, trading at around $700 to $820 per metric ton for the whole of 2013. Year to October average price is around $760 per metric ton, down 23% year-on-year. This is also one of the main reasons why there is an industry-wide year-on-year decrease in earnings this year for upstream CPO companies. For exports, Malaysia CPO exports remains robust in October, up 3% month-on-month, due to higher demand from Pakistan and China. For China, we are suspecting that there is a build-up in inventory for the Chinese New Year festival seasons as well as the beginning of the winter season, as CPO typically solidifies when temperature is cold. Based on a cargo surveyor Intertek, CPO exports, it's pretty much the same for the first 25 days in November as compared to the previous month. This goes to show that the exports still remains pretty strong in November. For Malaysia's inventory, as you can see in the diagram below, inventory continues to rise in October on seasonal factors. That said, inventory level is still hovering below the 2 million tons level for the 6 consecutive months. Production is typically peaking in October-November period, so we expect inventory level to continue to rise for 1 or 2 months before it starts easing in the first half of next year. Over at the supply side of the equation, CPO production in Malaysia in October continues to go up, as you can see on the diagram above, reaching a level of 2 million tons, up 3% month-on-month. Year to October production is also up by 4% year-on-year, indicating that the biological cycle is has a less impact on Malaysia's plantation estates as compared to its counterparts over in Indonesia. If you can see the diagrams below, Indonesia 3Q CPO production is still weak year-on-year due to the palm trees biological trend. This is mainly due to the fact that the average plantation age in Indonesia is younger, hence they are more prone to biological impact and bad weather. According to the USDA data, global CPO production growth in the marketing year of 2013-14 is expected to be lower at around 4.7%, which is the lowest year as compared to the past 3 years. All these factors are supporting the CPO price outlook. Having said that, if you look at the substitutes of CPO, which are the other global oilseeds like soybean oil, rapeseed oil, sunflower oils, you can see that the based on USDA data, we estimate that the stock usage ratio for marketing year 2013-14 is expected to increase to 13% from 12.1% in the previous year. This indicates that the supply alleviation is happening for the global oilseeds supply. Recent news from the South America also indicates that weather is improving over in South America. Hence, this actually boosts the supply outlook for soybean in the first half of next year. Also, EU last week also implement these biodiesel anti-dumping duties on CPO imports from Indonesia. This is also a negative for CPO price outlook, given the fact that about 90% of Indonesia's biodiesel export last year actually went to EU itself. One big wildcard for Indonesia's consumption of CPO is Indonesia's B10 biodiesel mandate. This policy, if it's successfully implemented, will actually spur domestic demand within Indonesia itself. But having said that, if you look at the chart below, you can see that the price discount gap between CPO and soybean oil price is narrowing from more than $300 discount to a low discount of only $90 per metric ton. This is also below the long-term average of around $203 per metric ton. Hence, we see no substitution catalyst for buyers to switch from soybean oil to CPO oil. So all in all, we believe that the CPO price will remain muted despite the low Malaysian inventory level, as well as the weak CPO upward in Indonesia. On the softer, based on three main reasons. First is the softer demand for during the winter season. Second is the anticipated higher supply of global oilseeds, particularly from South America in the first half of next year. And third is the narrowing discount gap between CPO and soybean oil, hence indicating there's no reason why buyers should switch from soybean oil to CPO oil. For the companies that we are covering over within the commodities sector, Golden Agri's Q3 results was weaker than expected due to high inventory on delayed deliveries. Management has indicated that the rise in inventory is mainly due to the late surge in production over at the CPO plantations. Hence, they are not able to sell within the end of 3Q, but management expects the level to decline in Q4. Low output on biological trend is felt industry-wide, so we are not so much concerned. Management also revised the full-year production guidance to -5% year-on-year, but I expect a recovery next year to around 5 to 10%. China's operation went back to losses due to the lower average selling price. We are a bit concerned over its operation in China due to its volatile, challenging environment, but management is confident of recovery in Q4. We remain neutral in Golden Agri with a target price of 50 cents. For Wilmar, Q3 results is above our expectations as well as above consensus expectations due to higher oilseeds and consumer products margins as well as a turnaround in sugar. Palm and laurix remains steady with a robust margin and volume despite the increase in additional capacity over in Indonesia, over in the Indonesia side. The higher margins is also mainly contributed from high value added downstream products such as oleochemical and biodiesel. Plantations are affected by the upstream plantations are affected by the weak output, which is felt industry-wide. We continue to like Wilmar International for its robust, vertically integrated business model. Its exposure to promising markets like China, India, Indonesia, and other Southeast Asian countries. We see Wilmar as a good proxy for Asia's growing food demand. We maintain a cumulative rating for Wilmar with a target price of 388. Over at the option marine segment, let us first take a look at the small mid caps. For Ezion, Q3 results were steady due to more SEUs deployments and a higher offshore logistic contribution over its Australian LNG projects. We continue to like Ezion for its good business model, with as they only take in contracts that have an ROE of at least 30%. Second is because of its high earnings growth visibilities. Out of the 29 SEU contracts, 14 are yet to be contributing. And its third is it's because of its undemanding valuation, with FY14 PE of less than 10 times. We value Wilmar based on the sum of the parts model. We maintain the cumulative with a target price of 253. For ISRA, Q4 results is within expectations. We see a turnaround in core earnings, mainly due to the reversal of the recovery of its subsea division. This leads to overall margins recovery of to a level of 17.9% from 0.7% in Q3. That said, we remain cautious as we believe that Israel will still need to have a series of good results before the market do a re-rating to the stock itself. We value Israel with a P multiple of 13 times FY15 EPS with a target price of 118. We maintain our neutral call on Israel. For rig builders, Keppel Q3 result is broadly in line, driven by property contributions thanks to its higher China property sales, as well as infrastructure utility business. Margins also showed a positive upside surprise with a margin of 16.5%. This is above our expectation of 14 to 15%. As you can see, there is a Keppel's O&M margins is on an upward trend, and we expect this to continue into Q4 with as there are 4 more jackup rigs yet to be delivered and are expected to be delivered by end of this year. The resilient O&M margin in Q3 is mainly due to the delivery of 5 KVLB class jackup rigs, as well as higher repair contributions. Things are not as good for its peers, Sembcorp Marine. Its Q3 results is slightly below expectations on low margins. In fact, the margins is on negative surprise at 10.1%. This is mainly due to the conservative initial revenue recognition of its new design rigs, such as well intervention and harsh environment semi-subs. For its drillship, it is on its way to its new Brazilian yachts, and it should be reaching the Brazilian yacht by February next year. So we will continue to monitor its margins as it executes its drillship over the Brazilian yachts. Hence, So currently, between the two, Keppel and Sembcorp Marine, we still favor Keppel based on 3 reasons. One is its resilient O&M margins. Keppel is expected to deliver a record number of 20 jackup rigs in 2013. This should lead to higher earnings. And out of 31 jackup rigs that is currently under construction, 17 are based on KVLB class proprietary design. this repeated design construction of its checkup rigs should create a higher productivity and higher efficiency, which in turn should lead to a sustainable O&M margins over the next 2 years. For Sembcorp Marine, we believe that margins will remain under pressure due to its as it executes its new design rigs for its drillship, well intervention, as well as harsh environment semi-subs. Why? Why is this so? We believe that this is mainly due to the learning curve tuition fees that they would need to take up as they execute these new design rigs. Typically, yachts will actually be more conservative for rig designs that are pretty new, and hence going forward, we see continued downward pressure on its margins in the near term. Second reason why we prefer Keppel Corp is because of its strong order wins. Year to date, it has already secured $7 billion worth of contract. This is excluding the 6 jackup order win along with its new Mexico yard with Pemex, which is worth about $1.2 billion. Order book at end of Q3 is $13.6 billion. For Sembcorp Marine order book, while order book jumped to 166% over the past 2 years, which is now at around $13.5 billion, which is similar to Keppel Corp. But with drill ships constituting to about 47%, we remain cautious because of the fact that drill ship is a new product. This may lead to lower margins, and hence the higher order book may not flow through to the bottom line. That said, the O&M outlook still remains robust. Fundamentals still remain strong. Management from both companies are optimistic as the inquiries for new checkups and semi-subs remains active. As you can see in the diagram below, utilization rate for ultra deep water rigs remains above 95%, indicating supply tightness, and oil prices still remain above the healthy range of $80 per barrel. This should lead to sustained rig demand. As for competition, we believe that Singapore yards still have a competitive advantage over its Chinese peers, despite the fact that Chinese peers has lower pricing and attractive payment terms. Why is this so? We believe that there's still ongoing concerns about the poor track record of the Chinese peers, as well as late delivery concerns. Singapore yards, on the other hand, has a strong track record. Hence, they can price their rigs at a higher premium. One good example is the recent contract win by Keppel Corp for 5 jackup rigs. This shows that established yards still prefer established drillers still prefers established yards at this moment of time. So all in all, we continue to like Keppel for 3 main reasons. One is this resilient O&M margins. Two is its strong order book wins, and thirdly is because of its attractive dividend yield of more than 4%. We value Keppel Corp based on some of the parts-based model with a target price of 12.07. We maintain our accumulate rating. As for Sembcorp Marine, we are neutral with a target price of 4.33. We keep our neutral rating because we believe that Sembcorp Marine will still have to incur learning curve tuition fees for its new design rigs. Hence, margins will be on downward pressure going forward in the near term. And special dividend, which Sembcorp Marine used to pay in the past in 2010 and 2011, will not be seen in the near term. We expect special dividend to only come back in FY15 on the lower capex requirement after the completion of both Singapore and Brazilian yachts. That's all we have today. Thank you. Questions, please. Sets. There's a question on Noble and our target price for Noble. We are currently for Noble, we are currently not covering Noble at the moment, but we see that the conditions over at its agriculture segment is improving. So we are continuing to monitor Noble, and if the condition turns good, we may initiate our initiation on Noble Corp. Entry point for
target price. I don't have a target. This is a fundamental target price. I mean, entry point is the. I can't give an entry point. It's impossible.
Then don't just ignore.
Or can you just tell them, because can you just tell them that we're understaffed now?
No, because they should follow our reports. When we say buy, they should buy already. When we are continuing our recommendation, it's because of our prior reports.
The rest of the questions.
We can ask, but we might not answer.
Because that we can't. Because normally, for the general answers, Josh will give For the counters that we don't cover, Josh will give his general opinion.
Oh,
see. So actually, so it's just so we won't be able to answer about this lah. I suggest we say that because of holidays, right now, no, seriously, next week more analysts will be around.
Okay.
And we'll detain more of the questions lah. We cut this one short.
You want to take the mic and explain to the rest?
You're more senior than me.
We can hear.
Oh. What sets? Genting. Hi, with regards to your question on Keppel and Sembcorp Marine, we have a target price for Keppel and Sembcorp Marine, but we don't have an entry price for that. Our target price for Keppel is 1207. Our target price for Sembcorp Marine is 433.
Yes,
target price
$2.04. The previous coverage on Boss is still good. I'm not sure what that means. There's a question on Balstead. The question is, Balstead has a recent run-up. Yes, That's true. But the question is not clear. It says the previous coverage on Ballstat still good. I'm going to assume that you mean are the factors indicated in the last report still still relevant? And the answer is yes. The fundamental issues of Ballstat are still relevant. So yes. So essentially, all the assumptions of the report is still the same.
There's a question on Sembcorp Industries, whether is it comparable to Keppel Corp. Well, we believe that Sembcorp Marine is a better comparable to Keppel, based on the fact that Keppel has a huge exposure to the rig building, offshore and marine business. It'll be a better comparable for that.
There's a question, can we propose questions from Japan? Of course, you're definitely welcome to ask your questions, but just note that for today, our macroeconomist is not in office today, but he'll be back tomorrow. So for the more regional questions, he'll be here next week to entertain such questions. But you're definitely welcome to ask. Another question is, based on the indices charts, do we foresee a major market correction sometime mid next year? Okay, based on macroeconomic data and basically where we think we are on the chart, barring any very unforeseen circumstances, there will definitely be a market correction. However, the expectation that it's not going to be a major correction. Yeah, there will be a correction, but it won't be major based on and that's because of the improving macroeconomic data. But of course, if there's some news or some crisis or housing bubble bursting, for example, in China, then that's a different story. We'll have to reevaluate it at that time itself. But as of right now, we believe that any market correction will not be a major one.
Respond to all so that everyone can hear it as well.
What do we say though?
For which question?
Sembcorp, this Sembcorp industry, you don't cover that now, right?
So the one over there.
There's a question on any target recommendation for Sembcorp Industry. We are not covering Sembcorp Industry at the moment, so we don't really have a target price.
Same for this one as well. We have a question on SIA Engineering. So as of now, we do not have coverage over that at the moment. We are going to initiate coverage soon, but not yet. So unfortunately, we have no in-house view of SIA Engineering at this point in time. I didn't mention that. I don't know what is in the annex. Oh, I think that's it. This is just to answer a question. Are we allowed to ask on other counters? Well, it's more of a practicality issue. So obviously, if you ask questions on the counters presented today, you have the benefit of the analyst who has done the research presenting today to answer you. So you can ask on other counters, but no guarantee that we have coverage on them. Obviously, if we have coverage on them or whatever details we know about them, we will share with you, obviously. Yeah, so please feel free to ask us on other counters. Okay, and with that, we shall conclude our morning call. So we'll see you next week. Oh wait, sorry, one last question. Last minute. Okay, I have a question. How about construction sector? There's a question on the construction sector. Okay, right now I can tell you that for the construction sector in Southeast Asia is robust. We are forecasting 5% construction spending year on year for Southeast Asia. Singapore itself is a bit more moderate, 3.5%. We forecast 3.5% infrastructure / construction growth from now, 2013 to 2018. So Singapore construction sector, we have moderate growth, and Southeast Asia in general has a more robust growth. And of course, the highest growth will be in China, which we forecast to be roughly 6 to 7% a year for the next 5 years.
Yep. Hi, there's a question on asking how is Singapore property market going to, what's our views on Singapore property market for 2014 with all the cooling measures. I believe this is more specific to the residential sector. I believe you will see quite a muted 2014. You can see the big developers scaling back on their launches over 2014 already. So expect a slightly more muted, but current price will most probably see maybe a 5 to 8% correction. And or if our base estimate, our consensus estimate is around the market will hold at current levels, because we feel that in 2013 it has already dropped quite a significant amount already, and that there will not be further discounts or further downside for the launch prices for the condos and all the private property as well. But having said that, we do have to keep in view that the government do review such policy every 6 to 8 months. And if the new policy coming out, they will actually have some downside towards the residential prices. So therefore, we kind of like, we feel that you'll hold at current levels, but we do recognize that there may be some downside to it. So it's not really that favorable outlook.
One question, any construction stocks which Philip would recommend? One of our recommended stocks is Pan United. You can find our latest report, in our website, Poem's website. Okay, Pan United is one of the market leaders for ready-made concrete, so they will be a good proxy for construction in Singapore. So please do take a look at our most recent Pan United report found on the Poem's website. That's another one again. Keppel Land.
Is it good to buy from Keppel? There's a question saying regarding, since Keppel Corp benefited from the property sales in China, or other Keppel Land, is it good to buy for? Sorry, give us a moment. Is it the other way around? Is it that since Keppel Land benefited from property sales, is it a buy for Keppel Corp? I'm sorry, I think we need to seek some clarification for the question. The question says that since Keppel Corp benefited the property sales in China, is it good to buy? Is it good to buy for Keppel Land? I think I assume that there is kind of a mix. Is since Keppel Land benefited from the property sales that it achieved in China, is it a good buy for Keppel Corp? Can we see? Is that? Do you want to retype the question and see whether there's any error? Yeah. If not, for Keppel, just to answer the second part of the question, is it good? As in, is it a buy call for Keppel Land? Currently, Keppel Land is actually they are holding up quite well as compared to the other two like for like competitors with Capital Land and CDL. The market, we believe that the market has sort of start to notice that its large exposure to China and also the strong performance, be it whether there are upcoming launches and also there are over the past 2 quarters of 1,000+ units sales in China, more than 10,000 units in China and whatnot. The market has sort of priced it in already. We would say that there is still some upside to it, but we only have an accumulate call or a neutral to accumulate for it So I wouldn't say that it's that strong a buy. But having said that, yeah, fundamentally it is the most safe, most sound developer in the market right now in terms of fundamentals. Alright, I believe that is all for this morning. Thank you all for tuning in. We hope to see you guys tuning in again. If there's any questions, please refer to the individual analyst that's covering which sector, and actually you can contact us directly or send it to a research email, and we will actually respond from there. Yep, thank you everyone.